Hello, welcome, namaste. In today's video, I am analyzing Tata Chemicals Limited. We'll look at the company's profile and from there on we'll move to checking out the detailed profile. This is a short profile and then we'll go into the detailed profile of the company, and from there on we'll look at the company's financial statements, the graph as well as the intrinsic value calculation. In between, we'll also do peer group analysis and compare Tata Chemicals with its peer group companies. Let us look at the segmental revenue breakup on a consolidated basis. These values are up to date till 2019. 11,296 crores was earned in 2019. Let us look at the breakup of the revenue. Basic chemistry products contributed the maximum of 8,300 crores. Consumer products, which has now been discontinued, contributed around 1,847 crores, and specialty products contributed around 2,026 crore. If we look at the segmental reasoned EBIT wise, that is how much top line profit the company generated based on different segments, the total EBIT was around 1,790 crore in 2019. Again, the basic chemistry products contributed the maximum of 1,304 crores. Consumer products contributed 314 and specialty products contributed around 172 crores. Let us look at from which regions the revenues are coming in. India contributes the maximum to the revenue of 47%. Asia, other than India, contributes approximately 8%. Europe is a slightly bigger segment of around 12%. America contributes the maximum at 30% other than India. And Africa contributes around 3%. So these are the regions from where the company generates its business. Promoter and promoter groups are holding around 30.63% stake in the company. Non-institutional are holding around 21%, and institutional, including DIIs, FIIs as well as mutual funds, have around 47.9% stake in the company. Tata Chemicals is the third largest soda ash manufacturer in the world. It's the sixth largest sodium bicarbonate manufacturer in the world. It's a market leader in salt in India as per its sales figure. Let us look at what soda ash is used in. It is used in detergents, float glass, construction and housing, commercial offices and retail spaces, as well as automotive sector. Then we have soft drink glasses, Indian made foreign liquor, pharmaceuticals, tableware, glass, etc. It is also used as a detergent chemicals like sodium bicarbonate, sodium silicate, other chemicals, dyes and intermediaries. Then we have the bicarb product, which is used in pharma sector. It is also used in animal food and poultry feed, in explosion suppressant, fuel gas treatment, etc. The company's consumer product has been demerged from Tata Chemicals, and company also has a specialty product. So the company has basically only two segments now. One is the chemical segment and one is the specialty product. Specialty product includes food, wellness, agricultural and advanced material. Let us look at a brief numbers of the company. In 2019, company generated around 2,095 crore of EBIT, which was earlier in 17 and 18 approximately 2,191 crores. So the EBIT has fallen slightly from 17-18. Profit after tax has decreased from 1,560 crores to 1,395 in 2019. Its market cap has decreased from 17,251 crores to 15,000 crores now. From here on, let us move on and look at the company's detailed profile. Okay, let's start our detailed analysis of the company's profile. Tata Chemicals Limited (TCL), established in 1939, is a part of Tata Group companies. Post a demerger of its consumer product business with appointed date as of April 1st, 2019, Tata Chemicals business segment include basic chemistry products, including salt making facility and specialty products. Tata Chemical, with a total consolidated soda ash capacity of 4.3 million metric tons per annum, continued to be the third largest producer of soda ash in the world with presence across the globe. Further, with over two-thirds of which being natural soda ash capacity, leading to efficient operations in terms of lower operating costs. It is also the sixth largest manufacturer of sodium bicarbonate in the world. The company has an established market presence in the crop protection business through its subsidiary Rallis. The company is the world's third largest producer, having a total market share of 6% approximately, with annual soda ash capacity of 4.3 MMT, about two-thirds of which is natural soda ash, and that leads to an efficient operation in terms of lower operating cost. Soda ash operations consists of natural soda ash, which is a low-cost plant in North America, synthetic soda ash plant at Mithapur, Gujarat, which is one of the lowest cost producers amongst others. The company's products are consumed by some of the world's largest manufacturers of glass, detergents, and other industrial products. The manufacturing facilities spread over 4 continents of Asia, Europe, Africa, and North America. The company's business is well diversified with its leadership position across various products and diverse geographical presence. The company's revenue in fiscal year 19 on a consolidated basis primarily included revenue from 3 segments, namely basic chemistry products, consumer products, and specialty products, which contributed around 74% for basic chemistry, 16% for consumer products, and 18% from specialty products. However, with demerger of its consumer products, the company will now have 2 segments, namely the basic chemistry products and specialty products. However, Tata Chemicals will continue to manufacture salt within the basic chemistry products business. Apart from soda ash, the company is also 6th largest producer of sodium bicarbonate in the world. The company is one of the leading agri-services and crop protection chemical companies through Rallis India, one of the India's leading crop protection companies, in which Tata Chemicals owns around 50.06%. Geographically, the company is present in 4 continents, and their contribution to the total income is Asia contributing 55.1%, America 29.54%, Europe 12%, and Africa 2.75%. The company had announced a demerger of its consumer products business from Tata Chemicals and merged the same with Tata Global Beverages by April 2019. Given the higher margin business of its consumer product, the EBITDA margin on a consolidated basis is expected to show a marginal decline of about 1%. The same is expected to be more than offset by improved focus on specialty products. Furthermore, in Q3 FY20, that is up till December 2020, Tata Chemical has acquired the remaining 25% partnership interest from the Andover Group for consideration of US $195 million, approximately around 1,372 crores of Indian rupees, thereby increasing its stake in the company to 100%. The acquisition is funded by external loan of US $175 million and balance from internal accruals. This is further expected to strengthen and maintain its leadership position in soda ash. Tata Chemicals continued to have comfortable financial profile marked by low gearing. Overall gearing on a consolidated basis improved to 0.4 times as against 0.44 times as on March 31, 2018. The company continued to report strong cash flows from operating activities on the back of stable operating performance, which remained at 1,580 crores in FY19 as compared to 1,870 crores in FY18 on a consolidated basis. In terms of soda ash production, breakup between domestic players, Nirma leads with 27% market share, followed by GHCL accounting for around 25% and Tata Chemicals occupying around 20%. About 24% of the demand continued to be met by imports. Hence, the planned capacity addition by Tata Chemicals in the next 2 to 3 years may be beneficial for the company. Any capacity addition from competitors is not expected to affect the company, as the company imports soda ash from its Magadi plant in Kenya, which despite the additional transportation cost remains cost effective. As the Indian market is expected to grow at slightly higher rate of mid-single digit, the company remains in favorable position to match the increased demand and derive accretive benefits. The company is presently implementing capex involving approximately about 3,600 crores to be spent over 3 years towards capacity expansion and future growth plans, which is proposed to be funded fully from internal accruals. The capex primarily includes about 2,500 crore rupees of capacity expansion for all products at Mithapur plant, a capex of around 800 crore rupees approved by Rallis towards expanding capacity to service growing global demand and build intermediary product manufacturing capacity for backward integration. During the first half of fiscal year 20, the company has incurred a total of 620 crore towards capex, including the aforesaid expansions. Soda ash is largely used in segments like flat glass, container glass, detergent, pulp and paper, alumina, metals and mining, etc. Bulk of the consumption, approximately 42%, is by glass and detergent. World soda ash capacity in 2019 was about 70.6 million tons. Net capacity addition in 2018 was around 2.9 million tons, with major contribution coming from Turkey. With full plant capacity coming on stream in 2019, there was a significant jump in its export volumes from 1.9 million tons in 2017 to around 3.2 million tons in 2018. Export volumes from China declined and were around 1.4 million tons in 2018. Lower Chinese volumes in Asia were adequately supplemented by exports from Turkey and the US. Turkey's maximum volume was directed to Europe, replacing US volumes. Soda ash business is highly dependent on macroeconomic factors globally. The demand for soda ash continued its strong growth in emerging economies of South America, Southeast Asia and Indian subcontinent. However, the demand in China remained weak due to restrictions on polluting industries. In view of this, the demand for soda ash globally is estimated to grow gradually in the lower single digits in the near term. Furthermore, the domestic soda ash business is exposed to the volatility in the international market-linked prices and cheap imports that further add an element of uncertainty. Liquidity comfort is derived through cash and cash equivalent of approximately 1,952 crores and investments in liquid mutual funds was somewhere around 2,253 crores as of March 19. As on September 19, the cash and cash equivalent stood at 1,690 crores and investments in mutual funds on a consolidated basis stood at around 2,323 crores. The cash flow from operating activities was at 1,150 crores in first half of FY20 as against 758 crores in first half of FY19. Liquidity is further strengthened by the fact that Tata Chemical derives strong financial flexibility, being one of the strategically important companies of the Tata Group, leading to its robust fundraising ability. So this completes my analysis of the company's profile. Let's move on and look at the company's financial statements. So let's start our analysis of the company's financial statements, beginning with the growth in sales compounded over 5 years, 3 years and the latest 12 months. For all the 3 periods that we are analyzing, we see a degrowth in the revenue compared to March 19, March 16 and March 14 values. So from March 14 to March 19, there has been a degrowth of around 6.5% over the period of 5 years. Whereas over the period of 3 years, there is a degrowth of around 8.7% from 14,800 to 11,200. And even in the recent 12 months, there is a slight drop of around 2.24% in the overall revenue generated. So we see a degrowth or a downward trend in the amount of sales the company is doing every year. So this needs to be investigated. One reason I see is that the company has demerged 2 of its business from Tata Chemicals. One was the fertilizer sector and the other is the consumer sector. So therefore that could be the reason why the amount of revenue that it's generating through sales is decreasing. If someone is aware of any other reason, do let me know in the comment section. The average profit margins for the last 5 and 3 years was above 15%. In fact, in the last 3 years, the margin have further increased to around 23.5%. March 19, the margin was around 18.5, whereas in the recent 12 months, the margin is around 19.5, way above my benchmark of 15%. So on a total sales of around 11,000 crores, the company's operating expenses is around 8,800 crores. Looking at the other income as a percentage of total sales from March 19 to the recent 12 months has been quite flat at around 573 crores. In fact, in March 19 also, other income contributed around 581 crores, which was slightly above 5% of the total sales value. So from March 19 to the recent 12 months, the values are quite flat. Depreciation charged as a percentage of total sales was around 5.8%. If we can see a very flat trend in the amount of value of depreciation that is being charged to the P&L account every year. In terms of value, in the recent 12 months, it was 644 crores being deducted from the total revenue. That's just 5.8%, and the trend is also very flat. So we can see that there is no manipulation going on in this particular portion. Raw material cost as a percentage of total sales in March 19 has dropped to around 20%, whereas in March 16 and 14 it was above 35%. So this needs to be understood. What is the reason for the company's raw material cost as a percentage of total sales dropping to below 20%? Employee cost is increasing to around 12% in March 19 from where it was in March 16 at 8.6%. So the company is paying its employees a good percentage of its sales or revenue generated. If someone is aware as to why the raw material cost has decreased in March 19, do let me know in the comment section. Company's interest outgo in the recent 12 months was around 340 crores, and that has been reducing from where it was in March 16 and March 19. So overall percentage wise, if we see, it is occupying just 3.1% of the total sales done in the recent 12 months. Sales has been dropping as we saw earlier, and the overall interest expenses is also reducing, which signifies that the amount of debt the company has been reducing gradually. Percentage wise also we see a very flat trend in terms of how much interest paid out of the total sales. Company's tax structure as of the recent 12 months has dropped to below 15%. This also needs to be understood as to why the tax rate has dropped below 15%. March 16 and March 19, the values were around 19.8% and 20%. Out of the total profit earned of around 1,739 crores in the recent 12 months, company paid a tax of around 251 crores. So this needs to be again investigated in detail as to why the company's tax payout is so low. If someone knows about this as well, they can put it in the comment section. Interest coverage ratio is above 4 times, which is my benchmark in the recent 12 months. In March 19 also it was above 4 times. In March 16, the interest coverage fell to around 3.4 times. In the recent 12 months, the amount of EBIT it generated around 2,079 crores. On that, it paid around 340 crores of interest expense, which is 6.1 times higher EBIT compared to the finance cost paid. And we should see a healthy interest coverage ratio for the companies that we are investing in. Net profit margin from March 19 and recent 12 months is above 10%, which is my benchmark, compared to March 16, where the profit margin had fallen to around 5.2%. In the recent 12 months, the overall sales done was around 11,044 crores. On that, the company earned a profit of around 1,237 crores. Average net profit margin in the recent 12 months was around 11.2%, below the 3 years average of around 14.5%, slightly above its 5 years average of around 10.4%. So we see that for both 5 and 3 years it has maintained above 10% of NPM. Let us look at the growth in profits compounded over 3 years as well as in the recent 12 months. From March 19 to the recent 12 months, the profits have grown from 1156 crores to 1237 crores in the recent 12 months, which is a 7% growth. If we look at the last 3 years, March 16 to 19, profits had been compounding at the rate of around 14.5% from 771 crores to 1100. But if you look at from March 14 to 19, which is a 5-year period, ignoring this value of 202%, in March 14 the company had made a loss of around 1000 crores. Against that in 19 it has gained around 1100 crores of profits. So definitely it has turned around from where it was in March 14. This value needs to be investigated if someone is interested into understanding why the company had made losses in March 14. Then they can go into the financial statement and look in detail, or even do a research on Google and understand why the company suffered losses in March 14. But since then it has turned around. In the recent 12 months, the company's sales were higher than its market cap. The company's value in the share market was around 6,400 crores for the entire company, whereas the company's sales were around 11,000 crores, which means that the market cap is 0.6 times its sales. That is, we are getting it at a discount to the amount of sales it is doing. Even in March 19, the figure was almost the same. March 16, the company's sales were huge at around 14,800 crores. Against that, the market value was just 4,245 crores. So we are getting it at a good market cap to sales ratio. Dividend payout in 16 and 19 were above 25%, whereas in March 14, because the company had made losses, the company did not pay any dividend in that particular year. And even as per the regulatory norms, if the company is in loss, they cannot pay dividend. The company's price to earnings ratio throughout the data that we have here on the screen has been very flat at slightly less than 6 times. So throughout the period, we are getting it at a price to earnings of less than 6 times. Average of the last 5 years stood at around 5.9 times. So the recent price earning is very nearby to its averages. Moving on to the balance sheet analysis, the company's equity share capital as well as the face value have been exactly the same throughout the years. Return on equity in March 19 was just 9.4%. I would like my companies to have at least 15% and above of ROE. March 16 also it was way below at 11.2%. That is, on a total net worth or shareholders equity of around 12,341 crores in the business in March 19, the company earned a profit of just 1,156 crores. That's a mere 9.4% of profits earned on shareholders' money. In March 14, the company had made a loss of around 1,032 crores, and therefore the company didn't generate any returns on shareholders' money in March 14. If you look at the last 5 and 3 years average, that also stood below 15%, and 7 years it was even lower at 7.6%. So company's return on equity is not very good throughout these years. Let us look at how it's managing its capital employed into the business. Here too we see a margin pressure in terms of amount of capital employed and the EBIT it is generating. Here too it is very low at around 11.3%. I would like the companies to earn at least 15% and above. Or we can look at the peer group companies where they are trading at, how much EBIT the peer group companies are generating compared to Tata Chemicals. In March 19, the amount of EBIT company generated was around 2,097 crores compared to the total capital employed of 18,485 crores. So we want to see the company generating higher and higher profits as it keeps increasing its capital employed into the business. From 15,945 crores in March 16, the company's total capital employed increased by approximately around 2,500. Return on capital employed over long-term average periods was also not very heartening, in the sense that in last 3 years the ROCE value was around 13.9 and in the last 5 years 12.9%. So company has profitability margin pressure over the years. So through this analysis we can understand what is happening in the company, whether the company is efficiently managing its resources like its inventory, or how much profit it is earning on the capital employed or on shareholders' money, and so on, if they have diluted their equity capital, and if they are depreciating their assets at a proper rate, then are they paying tax to the government properly throughout the years. All these things we can notice from this analysis. Return on assets in March 19 around 4.3%, from 26,000 crores of total assets, that is the balance sheet size, the company earned just 1,156 crores. That's a 4.3%. In March 16 it was 3.1%. And in March 14, as we saw, the company had made losses. So on total assets, it made a loss of around 1,032 crores. Debt to equity in March 19 stood at 0.5 times, whereas in 14 and 16 it was quite high at 1.5 and 1.3. That is, its debt were more than its equity contribution in the business. But in March 19 that has been turned around. Now it is 0.5 times. So on a total debt of around 6,143 crores, the company's equity contribution in the business was around 12,341. And if we look at the debt trend, we can see a decreasing trend, and as we earlier saw in the P&L account, the amount of interest it was paying had also reduced gradually over the years. And that is what trend we see here as well in the debt analysis, where in March 14 and 19, where it was above 8,500 crores, that has now reduced to around 6,100, and therefore the amount of interest it is paying is also reducing. Equity is contributing around 46% from where it was in 14 and 16 at just 28% in the total source of funds the company had. And we see a debt reducing, so these ratios are very good. As of now, if we can see from here on, the company seems to be improving its financials. And if we are getting it at a very good valuations, we can definitely think of buying, because now the company's debt is reducing, equity contribution is increasing, the coverage have become better, and even their return on equity is better. So we see a turnaround in this company in a way, and this is what we can understand through the detailed analysis. If we skip one or two or maybe more ratios, then there's a chance that we won't understand the actual position of what is happening in the company. There's no other way of understanding except to look at all these numbers in detail and get a picture or an actual movie running through our minds as to what is happening in the company. What is the company doing? How is it 5 years, 3 years picture, long-term picture? How is its short-term picture? What is it doing currently in the recent quarters? And so on. So understanding the company's profile, how it is working, what kind of products it has, all these things need to be understood if we want to invest wisely and not lose our hard-earned money. So we can see a reducing trend in the amount of debt the company has as a percentage of total assets. Price to book is trading at a discount of 0.5, and throughout the years we have seen the same trend where the net worth employed into the business was more than what it is valued in the market. In none of the years the company's market cap has increased above its net worth, and therefore we can see a flat trend of where the company was trading. And this can be also understood in a way because we saw earlier that the company's debt position in 16 as well as in 19 and 14 was very high, and compared to that now they have reduced it considerably, and therefore we can see a kind of a change or an up move in this company if we buy at a good price point. Debt to net profit is at around 5.3 times, where earlier in March 16 it was at 11 times, meaning the total debt of the company was 5.3 times higher than the profit it generated in March 19, whereas in March 16 it was 11 times. I don't want this ratio to exceed 6 or 7 times, which would again signify that the debt is not more than 6 or 7 times of the profit the company is earning in a particular year. So overall the debt to net profit trend has improved now to just 5.3 times. If some of the ratios you don't understand or you're having difficulty in understanding few of these ratios, you can watch my earlier videos, or you can even write to me in the comment section and I'll try to explain if you have not understood a certain ratio. Net block is the total fixed assets of the company after removing depreciation. So we are trying to understand how much fixed assets are occupying a percentage of total assets. So throughout the years we see a very high fixed assets employed into the business as a percentage of total assets. Almost more than 50% of the company's assets or balance sheet is into fixed assets. So this company is heavily capex intensive. In March 19, 50% of its fixed assets were occupying the total balance sheet size of 26,000 crores. So company's total assets is around 13,500 crores. If you find any mistakes or any values in figures which you feel that it's not correct, do let me know in the comment section. So I don't want this particular ratio to exceed 30 or 40% of the total balance sheet size, which would mean that a lot of money is stuck into fixed assets of the company. But if a company is capital intensive in nature, then they would have that much amount of assets into the business. Let us see how much is the depreciation on the total fixed assets of the company before deducting depreciation. So we see in March 19 the company's total fixed assets before removing depreciation was around 14,122 crores, and the company deducted around 571 crores as depreciation from that and transferred it to the P&L account, which amounted to around 4% of depreciation on the total gross block as of March 19. Now we have to look at the percentage wise. The trend from 14, 16 and 19 is very flat, which means that the company is not manipulating its depreciation percentage. Second thing to understand is that these assets that the company owns, they would be deducted over a long period of time, and therefore the depreciation value can be reduced down to less than 5%. Generally assets like building, plant, machinery, they go on for 10-20 years and they can be depreciated over a long period of time from the profits, and therefore we see a lower value. But we have to look at the trend. Although this value is low, but over a trend we see that this is what it has been charging to the P&L account throughout these years. So I don't see any kind of manipulation in terms of depreciation being transferred to the P&L account. Capital work in progress, that is how much work was still going on in developing fixed assets. So this signifies to us whether the company is in capex mode as of March 19 or not. In March 19, the company had been working on 774 crores of assets to be developed and transferred to the net block of the company. So we see around 2.9% of work going on into the business as a percentage of total assets. So this is a reasonable amount considering that it has increased from where it was in March 16 to March 19, but as a percentage it was just 3%. Company's cash holding as of March 19, and even if we look at the long-term trend of 14 and 16, had been holding above 1,000 crores of cash in its total assets, and this trend seems to have increased in March 19 to around almost 2,000 crores, which is occupying around 7% of the total balance sheet. I don't want this to exceed more than 15 to 20% of the total assets. Company's investments in mutual funds, shares have been increasing. This particular investment generates other income for the company. As of March 19, the company's total investments were around 5,615 crores, which was basically 20% of the total assets, a trend which has been increasing throughout. If the company has a lot of surplus cash, then it can invest into investing activity that can generate other income for it. For me, this percentage is a little bit high compared to the past years. We don't want the company to be holding a lot of investments until and unless there is no capital expenditure requirement. Company's debtor percentage, that is how much of the total assets was still to be collected from debtors or customers, that is how much payment was still to be collected from the customers, that in March 19 stood at 5.4%, and the trend has been reducing, which is very good. So earlier in March 14, the company had to collect around 3,200 crores from its customers out of the total assets of around 20, which further decreased to around 14%, and now it is mere 5.4%. Debtors turnaround in March 19 was around 13%. This signifies that as a percentage of total sales done in March 19, how much was still to be collected from the customers. So we can see that out of the 11,296 crores of revenue generated through sales, company's pending payment to be collected from the customers was around 1,400 crores, which is just 13%. Again, we see a downward trend, which is a very good trend to understand, because we don't want the company's debtors increasing substantially compared to the sales it is doing, in a particular year. Earlier in March 16, it was 24%. Although my benchmark is 30%, it was way below that, but it is still a high value considering that in March 19 it has managed to reduce it to 13% now. So this is again a good trend to observe. How fast the company is collecting payment which is pending from its customers. In March 19 it was just 47 days and substantially reduced from where it was in March 16, where it was giving its customers 88 days to pay them back, whereas in March 19 it has dropped substantially to around 47 days. So this is again a very good trend to observe. Current ratio in March 19 has become little weak at 0.8 times, meaning its assets or current assets were falling short to pay its current liabilities of around 8,420 crores. So we want the assets or current assets in a particular year to be slightly more or at least equal to the liabilities it has to pay. Otherwise, the company will have to tap into its internal resources to clear this payment gap of current liabilities. So earlier we saw that the company had a very good cash holding as well as huge investments so that it can use to pay off these liabilities. Earlier in March 14 and 16, the current ratio was above 1 times, which was a good value considering that in March 19 it has slightly weakened. Inventory percentage in March 19 was around 6.4%. So out of the total assets of 26,900 crores, 1,726 crores was stuck in the inventory. This is the amount of work that was going on the development of goods for sales. Over the years we see a downward trend, which is again a good value. On a total assets of around 26,900 crores, 1,726 crores of inventory holding is a good percentage. I don't want this to exceed more than 20 or 30%. In terms of how much sales was done against the inventory holding, here we see a reducing trend. We want to see an increasing trend instead, where we want the company to sell as much as possible against the inventory it is holding. Another thing we notice in this is that the inventory holding is quite flat. So the company has been maintaining its inventory holding position. Although the amount of sales has been dropping from where it was in 14, 16 and 19, the inventory holding value is very stable and flat. And therefore we see, because the sales is dropping and the inventory holding is very flat, we see the multiple dropping. We want an increasing multiple. That is, the company should do as much higher sales as possible against the amount of inventory it is holding. That shows efficiency of the management. Moving on to the cash flow statement analysis. This is a very important ratio to understand, and I would suggest all the people who are watching this video to pay attention to this particular ratio. It's very important. In March 19, out of the 1,156 crores of profit declared, the company received additional cash from operating activity of 1,581 crores. I've made a separate video on net profit and CFO. You can check out in the ratio playlist where I've explained what exactly this ratio means. But to give you a short synopsis, what we want to understand here is, if the company has declared a certain net profit, can it show actual cash for that net profit? Can it account for that net profit? That is what we are trying to understand. So here, whatever profit the company has shown, that has come in by way of cash, and the amount of cash from operating activity is 37% more than the profit declared. Whereas in March 16, the company's cash coming in was way higher at 203% or 2 times higher than the profit declared. In fact, in March 14, at the time when it had made losses, the cash inflows were around 2,300 crores. So even though the company was showing losses for whatsoever reason, but here what we want to try and understand is, had the company received cash, and yes, it did receive in March 14 an excess cash of around 2,338 crores. So this gives me now confidence that even in March 14, although the company showed losses, it did receive a high cash. And if someone is really interested in understanding this in more detail, they can go into the March 14's annual statement and look at the cash flow statement and understand why the company had made losses and why it received positive cash from operating activity. So this is very important, and we have to see that company receives cash every year against the profit it is declaring. If you look at the long-term trend of last 3 years total, 5 years and 7 years in total, we see that throughout the years on a long-term basis, In last 3 years, it received 52% excess cash than what it showed as profit. This profit and cash are one and the same thing. It's just that when we say profit, it is from the P&L account, and when we say cash from operating activity, it is from the cash flow statement. So what we are basically trying to understand is the company receiving cash of against the profit that it is declaring? And that is very important to understand. I cannot stress this enough. In 5 years, company's cash coming in was around 78% higher than the profits declared. So in the last 5 years, total cash inflows were around 10,588 crores against the profits of 5,900 crores. In last 7 years, the total cash inflows were around 13,000 crores against the profit of 5,300. So in every long-term trend, we see that the company's cash inflows were higher than the profit it was declaring. And therefore, like we have the net profit margin, we can have cash profit margin. So we can calculate against the cash what is the margin or what is the sales margin that the company has been doing. Now let us look at this second part where we are comparing the amount of cash the company is earning every year, and of that cash how much it is putting into investing activity. This investing activity would involve buying of fixed assets, selling of fixed assets, as well as buying of investments, that is mutual fund shares, as well as selling. So both buying and selling of fixed assets as well as mutual fund shares, etc. So in March 19, the company's total cash earnings were around 1,580 crores. Against that, it invested 1,927 crores, which is 122%. I don't want the companies to invest more than 50% of their cash earned into investing activity until and unless there is a high growth or the company has to put in more money into buying of assets. And as you earlier saw, the company's assets were huge at around 50% of its total assets in the balance sheet. So therefore, we can assume that the company would invest a substantial portion of its cash earned from operating activity into buying of assets or also doing investments. In fact, in March 19, we also saw in the balance sheet that the company had done huge investments, or its investments as a percentage of total assets were very high, and therefore we can see that getting reflected in the cash from investing activity of around 1,927 crores. So this particular portion, if someone wants to go into more detail, can go into the cash flow statement and understand what kind of activity has taken place in the investing activity part. In March 14 and 16, it was a reasonable 24% and 20%. So out of this 2,300 crores of cash earned through operating activity, only 463 crore went into the investing part. So this was a reasonable value. In March 19, that has increased quite substantially at 1,927 crores. Let us look at the long-term trend, how the company has been doing in the long term. If we see in the last 3 years, the trend was very good at just 3%. That is, out of 6,982 crores of cash earned through the operating activity, only 196 crores was spent in investing activity. In 5 years, it was just 13%, and in last 7 years, 16%. So this 3% or 196 crores put into investing activity is the net of the 3 years. That is, it's the total of the 3 years. So we see a good percentage in the long-term trend. Now let us look at the cash profit margin finally. This is a new ratio that I have put in this video. That's the cash profit margin. Just like we have net profit margin, we can have cash profit margin based on the operating cash flow. That is, on the total sales, how much cash the company earned through operating activity. Here we can see in March 19, this was 14%. In March 16, the cash profit margin was around 15.7, and in March 14, it was 14.7. So when we look at the sales and compare the cash, we see that the company has been earning a pretty good margin on its sales as per the cash received. Next, let us look at where the current market price is compared to where it was in 16, March 14 and March 12. That is 3 years back, 5 years back and 7 years back. The current market price stands at around 254 rupees, and in March 16 it was 166 rupees. When we look at it in this way, we see that overall the price is around 52.5% up from where it was in March 16, and it has been compounding at the rate of around 15.1% every year from March 16 onwards. That is, if someone had invested at this rate in March 16, they would have compounded or multiplied their money at the rate of 15.1% every year, or gained a total of 52.5% in last 3 years. When we look at from 5 years perspective, the prices had been compounding at the rate of around 14.7, whereas total gain from 14 was around 98.4%. That is, in 5 years, you could have expected to double your money, almost double your money. From 7 years on, we see a compounded growth rate of around 7.4%, and the total price increase was approximately around 64.4%, from 154 rupees to 254. So even if we look from 7 years back, we are getting it at a good multiple in terms of just 64% gain in last 7 years. So the current market price has fallen substantially, and we are getting it at a good multiple compared to where it was 7 years back. Finally, let's recap the valuation ratios. Price to earning is at 5.2, a good low multiple. We'll have to compare this with its peer group companies. Price to cash stands at around 4.1, again a good valuation. Price to book and market cap to sales both are trading at a discount to their individual book and sales value respectively. Moving on to the quarterly P&L account analysis, here we are trying to understand what is happening currently in the company, what kind of sales the company is doing, and against that what is the profit it is earning. Sales has grown at the rate of 2% YOY from December 18 to December 19, and from its previous quarter of September 19, it has seen a degrowth of around 5.3%. Profits have grown at 6.5% YOY, whereas in the quarterly analysis we see a 34% degrowth. That is, in September it had earned 355 crores, and in December 19 that has dropped to around 234 crores. So quarter on quarter both sales and profits have seen a degrowth, whereas if you look from 1 year back, it has seen a positive growth rate. Finally, looking at the net profit margin on a quarterly basis, in December 19, the company's net profit margin fell below 10%. In December 18 also it was low at 8.5%. On a quarterly basis, the company's profits were 234 crores in December 19 compared to the total sales of around 2,620 crores. So this concludes my analysis of the company's financial statements. Let's look at the peer group comparison. In my peer group analysis, I'm comparing Tata Chemicals with Pidilite and Aarti Industries. The current market price of Tata Chemicals is 254, Pidilite at 1400 and Aarti at 943. The scrip is down by around 27% for Tata Chemicals from its 52 weeks high. Compare that with Pidilite and Aarti, which have fallen just 14 and 12% each. The results are up to date till December 2019. This data has been sourced from screener.in. Looking at the YOY growth rate, both Pidilite and Tata Chemicals have shown a positive growth rate over December 18 to December 19 quarter of around 2% and 4.3%. Aarti has seen a degrowth in its sales by around 4.5%. Looking at the profit growth rate YOY, both Pidilite and Aarti have seen a positive growth rate, whereas Tata Chemicals has seen a degrowth of around 3.3% in its net profit from December 18 to December 19. Degrowth means less profit from its previous quarter. Comparing the sales of the recent 12 months with sales of 2019, we see a slight degrowth in the amount of revenue it has generated in the recent 12 months. Pidilite sales have increased slightly from 7,000 to 7,300, whereas Aarti has seen a slight drop from 4,700 to 4,400 CR. So most of these companies are very nearby to their 2019 values. Checking out the profits of the recent 12 months with 2019, Tata Chemicals profits have increased. Even though their overall revenue has decreased marginally, the profits in the recent 12 months has gone up. Pidilite and Aarti Industries have also seen a growth in their recent 12 months profit from 2019. Comparing the profit of 2019 with the amount of cash these companies have received, both Tata Chemicals and Aarti have received higher cash compared to the profit that these companies have declared. Pidilite's cash has come in little less than what it showed as profit of 938 crores. So both Tata Chemicals and Pidilite's profit after tax values are almost very nearby to each other. But compare that with the cash coming in, Tata Chemicals is receiving higher cash compared to Pidilite. The current price earning of Tata Chemicals is the lowest available at 5.6 times its earnings, whereas Pidilite is very expensive at 61 times its earnings, and Aarti is at 29. So both Aarti and Pidilite are above my benchmark of 25 times. Looking at their averages, Tata Chemicals price earning is way below its both 5 and 3 years price earning. Comparing that with Pidilite, the averages were quite high at around 41 times. Compare that with the recent or latest price earning of 61, so it is way above its average. Even Aarti's price earning is above its average of 3 and 5 years. Expensive in terms of price to earnings. In terms of price to cash, again Tata Chemicals is available at the very good valuation of 4.1 times compared to Pidilite at 88 and Aarti at 22, which signifies that these companies are highly valued by the investors in the share market. The current market price to the book is trading at a discount for Tata Chemicals, and Pidilite is going at a price to book of 17 times, whereas Aarti is at 5.8. So both of these companies have been highly valued. The PG of Tata Chemicals as well as Aarti are both below 1.5. So these are both good price earning multiple. So both the company's price earning multiple is pretty decent because we are also getting a high growth rate in their profits over both 5 and 3 years. If you observe for Tata Chemicals, we paid a price to earnings of 5.6 and we are getting a growth rate of around 8% over a period of 3 years. Even ignoring the 25% growth rate of the last 5 years, we can see that in the recent 3 years, 8% growth rate in the earnings, and for that earnings we paid 5.6 times higher price. So it is justified. Looking at Aarti, we are paying 29 times its earnings, and the earnings for both 5 and 3 years period is growing at about 20%. So here too the PG has dropped below 1.5. PG is calculated by dividing the price to earnings with the profit growth rate or the historical profit growth rate of 5 and 3 years. All the three companies' profits have been growing in a positive figure for both 5 and 3 years, whereas sales has seen a degrowth for Tata Chemicals in both the 5 and 3 year projections of 6.6 and 8.8% over both 5 years and 3 years. Pidilite and Aarti has seen a positive growth rate in their revenue, which is a very good value because we want the company's revenue or sales to be growing consistently over where it was 5 and 3 years back. This value of 6.6% degrowth signifies that the sales of 2019 is below what it did 5 years back and what sales it did 3 years back. ROE for Tata Chemicals stands at 8.3% for 2019, whereas Pidilite and Aarti are giving a very high returns on shareholders' money of 24.3 and 23.3%. If you look at the 5 and 3 years average, Tata Chemicals is somewhere around 14.1 and 15.1% for both 5 and 3 years, whereas Aarti and Pidilite both are giving about 20% of ROE over these 5 and 3 years average period. Even in terms of ROCE, both Pidilite and Aarti are giving above 15% of return on capital employed. So these companies are giving a very high profitability on the total capital employed as well as shareholders' money and also on the total assets, whereas Tata Chemicals has seen a lower margin on the capital employed, equity as well as total assets. And that is why both Pidilite and Aarti are trading at a higher premium compared to Tata Chemicals because their profitability ratios are very high compared to Tata Chemicals. In terms of asset turnover, Tata Chemical has sold less than what it held as assets in the balance sheet, whereas Pidilite's sales are even higher than its assets. This particular ratio, asset turnover, tells us how efficiently the company is managing to turn over its assets into sales. That is, on the assets it holds, how much sales it is doing. So the higher the value, the better it is. Aarti's sales is also very nearby to its assets. In terms of inventory turnover, all of these companies are very nearby to each other over both 2019 as well as 3 years back inventory turnover. Here too we want the values to be as high as possible. Looking at the long-term picture of the profits earned and against that how much cash the company received, and out of that cash how much was left over as free. Tata Chemicals' total profits in the last 5 years stood at around 5,600 crores, against which it received a cash of around 10,588 crores and had 6,883 crores left as free. This ratio I have explained in my earlier videos in detail. If someone doesn't understand here, they can always refer to my older videos. But I'll give a short idea as to what this means. Whatever profits the company has declared, it has to receive it in cash, and here it is receiving almost twice the profit it earned in 5 years as cash. And out of this cash, it has 6,800 crores left as free. So the balance of the two, that is 10,588 minus 6,883, the balance of this was invested in purchase of assets or fixed assets, and the free cash flow of 6,800 can be used in the financing activity like giving bonus or doing repayment of loan or repayment of debt and so on. Pidilite has earned around 4,000 crores in the last 5 years in total. Compare that with the amount of cash it is receiving is slightly less than the profit declared, although it is not far away from the profit shown, and it has a free cash flow balance of around 2,600 crores. So in terms of cash management, Tata Chemicals has done the best out of these three companies. Aarti has shown a profit of 1,590 crores in the last 5 years in total, against which its total cash inflows were 2,400, so above its profits. But when we look at the free cash flow, it doesn't have anything left over for the financing activity. In fact, it has spent more into development of its assets. So whatever cash it earned in these 5 years of 2,454 crores, it has invested back into its assets, into developing its assets, and over and above that it has invested additional 225 crores. So these three ratios are very important to understand in terms of free cash flows and cash flow from operations. Average profit after tax of Tata Chemicals every year was around 1,135 crores. Pidilite managed to generate a profit every year of around 813 on an average basis, whereas Aarti Industries profits were around 318 crores. Let us look at the market cap and net worth. Tata Chemicals market cap currently stands at around 6,400 crores, whereas Pidilite has been given a very high premium of around 74,745 crores, which is, according to me, a very high premium or valuation, and therefore it does not justify buying into this company. The net worth of the company is just 4,375 crores. Figures given by screener is not wrong, then this is the actual values. Aarti Industries has also been given a high premium of around 16,000 crores in the market compared to its net worth of just 2,883 crores. So we are getting Tata Chemicals at a discount to its net worth. Looking at the contingent liability, all the three companies' contingent liability seems to be less than 10% of its net worth. So this is in a good range. I don't want the contingent liability to exceed 20% of the net worth. So here the contingent liability is alright for all the three companies. In terms of debt to equity, Aarti's debt is at 0.64 times its equity, highest in the group, followed by Tata Chemicals at 0.5. Pidilite is a debt-free company, and therefore its coverage is highest at 52 times its EBIT, whereas Aarti Industries at 6.32 and Tata Chemicals at 5.85. So all these three companies are doing good in terms of managing their debt position at a certain level to its equity, as well as earning a good EBIT to cover the interest cost. Tata Chemical promoters are holding around 31%. The highest promoter holding is in Pidilite at 69, followed by Aarti at 47, and none of the promoters have pledged any of their shares. In terms of how many debtors were still pending to be collected against the sales of 2019, all the three companies have managed a very good value of less than 20% against their sales of 2019. So all these three companies are very efficient in terms of keeping their debtor position at less than 20% of the sales. But in terms of collection, as to how fast it is collecting payment from the customers, Aarti Industries is taking the highest number of days of around 60, followed by Pidilite at 54. Tata Chemicals seems to be the most efficient and collecting within 46 days. Net profit margin for all the three companies is above 10%. The highest is for Pidilite at 13, followed by 10% each for Tata Chemicals and Aarti Industries. Tata Chemicals dividend yield at current market price, since it has fallen the highest in the group, its dividend yield also will be the highest compared to the dividend it paid last year at 4.92%, and Pidilite and Aarti are both giving below 1% of dividend yield. I have added a few more ratios here in this video to understand it in much greater detail as to what is happening in the company. Current market price to sales gives us an understanding about the valuation we are paying against the sales done for each share. Tata Chemicals is available at a discount to its total market cap. That is, its market cap is way below, almost half of its sales. So we're getting at a discount to its sales. Whereas Pidilite is trading at a premium of 10 times its sales. That is, the entire company is going or is available at 10 times higher than the amount of sales it is doing every year. Even Aarti Industries market cap is around 3.74 times higher than its sales. I don't have a benchmark here, but we can cross compare it with each other. The 5 years operating profit margin gives us an idea as to what is the top line profit these companies are earning on an average basis. The highest was Pidilite at 20%, followed by Aarti at 19.1% and Tata Chemicals at 17.99%, almost 18% for Tata Chemicals. The enterprise value to EBITDA again is a valuation ratio which compares what is the enterprise value of the company and against that what is the EBIT it is earning. So here too we want it to be as low as possible. Tata Chemicals is available at the best valuation, which means that its enterprise value is just 4 times higher than what it is earning as EBITDA, whereas Pidilite is going at an extreme premium of 42 times, followed by Aarti at 17.7. Here too I don't have a particular benchmark, but we can do a cross comparison and understand what enterprise value these companies should be having to buy at a good valuation. Current ratio for all the three companies for 2019 is quite comfortable at above 1 times. Let us look at the 7 years of cash earned through operating activity and compare that with the amount of free cash flows these companies are having. This is a new ratio that I have added here. Tata Chemicals in total of the last 7 years have earned around 13,146 crores of cash through operating activity and has 8,264 crores left as free, whereas Pidilite has earned around 4,760 crores and Aarti has earned around 3,000 crores. Yet Aarti's free cash flow over the period of last 7 years is still negative. I don't like to invest in a company which has a negative free cash flow. Even though they are investing heavily in fixed assets, I don't want a haphazard growth in terms of investment in fixed assets. There should be a systematic investment, or there should be a systematic growth in the amount of money these companies are putting in developing the fixed assets. Out of this 4,700 crores for Pidilite, it has 3,248 crores left as free. So this is a good ratio for Pidilite. Let us look at the 1 year return. Tata Chemicals has given a negative 4.65% return over a period of 1 year. That is, if someone had invested 1 year back, their portfolio would have shown a 4.65% drop, whereas over a period of 3 years, it would have shown a 3.71% drop. From 5 years back, it would have shown a 5.64% gain. The lowest gain in the three companies is for Tata Chemicals, whereas Pidilite from 1 year back, it would have shown a 17% gain, from 3 years back 27%, and from 5 years back around 20%. For 1 year return, this is the absolute return, whereas for 3 years and 5 years, this is the CAGR growth rate over the period. So both Aarti Industries and Pidilite have compounded the investors' money at the rate of more than 20% since last 3 and 5 years. So both Pidilite and Aarti have given a good return to the investors over these periods. Looking at the balance sheet total gives us an idea as to the size of the company. Tata Chemicals' total balance sheet size as of 2019 was around 26,900 crores, Pidilite at 6,300 and Aarti at 5,800. So both of these companies, Pidilite and Aarti, have been given extreme high premium in the market by the investors compared to Tata Chemical. Although by size it is almost 3 times bigger than Pidilite. The debt position for Tata Chemicals stood at around 6,100 crores. Pidilite's debt is very low, as we earlier saw debt to equity was very low. Aarti is at 1,800 crores. 3 years back, if you look at the debt position, Tata Chemicals debt has reduced from 9,000 to 6,100. Pidilite's debt has slightly increased from 80 to 129, whereas Aarti's debt has also increased from 1,200 to 1,800. Checking out the gross block and the accumulated depreciation gives us an idea as to what is the asset size of the company, or how much assets these companies are investing in their business, and how capital intensive in nature these businesses are. We can see that the total gross assets of the company for Tata Chemicals as of 2019 was around 15,600 crores. Nowhere near was Pidilite and Aarti in terms of asset base Tata Chemical is holding. Pidilite has an asset base of around 2,500 crores. Compare that with Aarti at 3,300. The total accumulated depreciation measures the amount of depreciation which has been transferred to the P&L account till date on the assets the company still has on its balance sheet. Tata Chemicals has transferred around 2,000 crores, Pidilite has 1,000 and Aarti at 1,200. So both Pidilite and Aarti's accumulated depreciation is almost 50% of the gross block. So most of its assets have already been depreciated to the balance sheet till date, whereas Tata Chemicals has to depreciate a huge amount of assets over the future years into its P&L account, and therefore we can see a constant deduction of depreciation over a long period of time in Tata Chemicals P&L account. If you don't understand any of these ratios, do let me know in the comment section, and in the next video I'll try to elaborate on those particular ratios. Checking out the amount of cash holding, Tata Chemicals seems to be holding the highest value of cash in its balance sheet at almost 2,000 crores, whereas Pidilite and Aarti are both holding less than 350 crores. Finally, we'll look at the institutional holding in these companies. FIIs are holding around 9.8% in Tata Chemicals, whereas DIIs are holding almost 38.3% in Tata Chemicals, highest in terms of domestic institutional holding, whereas for Pidilite and Aarti it is just 4.6% and 8.2%. Mutual funds are also holding a huge portion of Tata Chemicals of almost 22%. So this tells us that big fund houses, in terms of domestic fund houses, are holding a huge substantial number of shares in Tata Chemicals compared to Pidilite, whereas FIIs are also holding a substantial stake in Tata Chemicals. So this gives us a confidence that big investors are already invested in this company. I'm assuming these values of institutional holdings which I have sourced from ticker tape are correct, and therefore based on that I find Tata Chemicals worth investing, because if high net worth individuals are investing in it, there has to be some basis for that. Also, when we look at the overall numbers, and if we are comfortable with that, we can think about investing in a gradual manner. So this completes my detailed peer group analysis. Moving on, we'll look at the graph as well as the intrinsic value calculation. Let's analyze the graph of Tata Chemicals. We can see here on 6th March 2020, this is a weekly candle or a weekly price. One candle represents the price of 1 week. There's a huge fall here. This fall was due to demerging of the consumer business from Tata Chemicals, and here whoever was invested had got shares of Tata Beverages, and the price of Tata Chemicals had fallen down. But before this, I would like to just explain the setup of my chart quickly. I look at the relative strength index oscillator to start my buying when both the lines of RSI come below 35 and one of the line has to go below 30 for me to buy. So one has to be below 35, the green one, and the other one has to be below 30 minimum, so that I can start my buying. So for the first time in March 2019, when the price was 577 rupees, RSI line had already come below 30 and has come up again to 34 and 34.7. So both the lines are below 35, and therefore we can buy here at 566. Going ahead, the relative strength index had crossed above 70. By that time we have to already sell it. So here the selling had already happened. Next, we have to again wait for the RSI to fall below 30. Next, we have to again wait for the RSI to fall below 35 to start buying. So I've drawn support and resistance lines on the screen, but based on these we don't have to buy 461, 376, 309. These are the past support and resistance lines which I've already drawn. But as per the chart, we had to start buying on 3rd April 2020 when both the RSI lines were below 35. So one was at 34.8 and the other was at 18.1 RSI, and the price was 218 rupees. This is the time we should start buying from here on. I have a lower levels of 177, 119, and on the upside I have a price of 256, 309, 376. Even if the price doesn't go down and keeps moving up, we can buy at these levels of support and resistance, or we can break up our investment into multiple parts of 10 times and buy every 5% up or every 5% down, so that we can exhaust the amount of money that we want to put into this company. Also, we can notice here that as of 21st April 2020, when I'm looking at this graph, both the RSIs are below line 30, which according to me is a double dip, and therefore this is the extreme valuation that a stock can come to. And I generally buy when both the lines are below 30, so that I get a best price possible to start buying. So if from here on also we don't have to buy everything at one go. Let the price fall down, and every fall of 5% we can keep buying, or 5%, even if it goes keep moving up 5%, we can keep buying 5% up, so that our average becomes very good and stays near the price. Never buy everything at one go. Have patience, buy slowly and gradually into the company. The market will give you a chance. Even if it doesn't, you can still buy a little bit up, it doesn't matter. Already the current price is at a high oversold level, and therefore as of today the price is available at a good valuation. This is not a recommendation, this is what I would do. You should take a call based on what I've explained earlier about the fundamentals, about the peer group analysis, as well as the company's profile analysis that I did. So I'm doing this particular video for helping investors into understanding what the company does, and I don't want you to ask me what price I should buy. I'm explaining everything in this video in detail so that you can take an informed decision. If you have any other question other than the price, you can always ask me in the comment section and I would be glad to help. So this concludes my analysis of the graph of Tata Chemicals. So let's move on and look at the intrinsic price of this company as per the fundamental projections of growth in profit, sales, balance sheet, equity, and so on. Looking at the intrinsic price calculation, it so happens that the average of these four prices of four intrinsic value targets that I have of 260, 254, 251 and 246, the average of these four comes to around 253.4, whereas the current market price is very nearby or almost exactly at 254 rupees. So my projection of growth in sales, profits, cash flows, balance sheet and equity gives me an average intrinsic value of around 253. So the current market price and the intrinsic value are exactly at the same point, and from here on downwards we can start buying. I don't have the upside target, but generally whenever RSI indicator does a double dip and both the lines fall below 30, I generally expect the prices to rise by almost 100% from there on. So my target from here on is almost 100% in prices of Tata Chemicals. Do keep in mind that these are just projections of mine and it may not come out true, but I generally expect that it would go around 100% from here on. So this completes my detailed analysis of Tata Chemicals, and I would want to buy into this company as my own personal investment. Do take an informed decision based on what I've explained in this video. If you like this video and have any suggestions or you have any queries or questions for me, do let me know in the comment section. Thank you for watching this video. Dhanyavad. Namaste.